I'm delighted to be joined by Omar Najia, Global Head of Derivatives at BB Energy, Peter Maguire, CEO of XM Australia, and Jamie Ingram, Senior Editor at MEIS. Great. Good morning to you, gentlemen, again. Happy Monday. We're nearly finished with November. Let's start with Jamie, please. We have a few bulletin headlines there today, Jamie, and of course, one or two of them are centering around OPEC having delayed its meeting last week. They still have to meet. They still have to agree on something in the next few days. So what do you think, what would you say they're going to focus on in terms of clarifying their path forward? Are they going to be addressing this quota issue for African countries, or just sort of saying, okay, we'll let you know next month what we're planning for the first quarter?
Thanks, Diala. Yeah, it's there was a lot of rumors flying around last week. A lot of mystery going on ahead of the planned talks on Sunday, quite frankly. And so it was clear that something was going on. And when this postponement came out, yes, it was a surprise, but also it was clear that there were talks going on that hadn't been progressing as hoped by delegates. As you rightly point out, from our discussions with people involved in the talks, this issue of new quotas for the African contingent has been front and center of the delays. Essentially, they signed up in June for adjustments to the quotas. A lot of the African countries were provisionally handed out significantly reduced quotas. Now, the thing is that it's one thing to sign up to this and agree on your quotas being cut. It's an entirely different matter to then get around to implementing that 6 months later. So these countries, the likes of Nigeria and Angola, these independent assessments came through saying your quota is going to be cut by X amount, and they turned around and went, I think this is not quite accurate. I think that actually we are able to produce more than you're saying we can, and so our quota shouldn't be cut as much. So now this brings us to the current situation where the meeting's been postponed from yesterday until Thursday. Talks have been going on ever since the initial postponement, all the way through the weekend, and I would say that it's more than likely that OPEC Plus will manage to seal the deal on whatever adjustments they come through in time for Thursday. They've given themselves more than enough time to manage this, and some of the guys running the show are very persistent. So I think that Nigeria and Angola will essentially take what they are given to some extent. There's also the issue of compliance. This is an issue that often goes under the radar when oil prices are motoring along quite nicely. So going into this meeting, up until a few weeks ago, everybody thought absolutely fine. Nobody's going to care too much about compliance. Then oil prices dropped. Suddenly that comes sharply into focus. And on top of that, suddenly you had some news reports floated about deep cuts of maybe up to 1 million barrels a day. That took a lot of delegates by surprise. So suddenly it wasn't just the Africa quota cuts. There was quite a few issues going on. OPEC kind of left themselves with a little bit too much to do for the original deadline.
Yeah, okay. Well, I'll come back to you on that compliance issue regarding, the big producers who obviously want to increase their quotas, not just hold on to the quotas that they've been given, like the African countries. Omar, let's go to you for that. I mean, you've been saying that you're, medium long-term bullish for oil into next year once we perhaps hit new lows. I had someone on the show last week who said that they expect oil to drop as low as 64 before we kind of stay there or turn around. Do you think we could go as low as that? And what difference would it make what OPEC does, do you think, that?
I think basically, if you want to look at this market technically, if we set a new low below on WTI below 72.16, very possible, I think that you say that minimum conditions have been met to the downside. Now, whatever that number is, it could be 68. Can it be 64? Yes, it can be 64. But the big issue is that I think that this is a counter trend move, and the larger trend basically is to the upside. So if you took out 63 something, I think it was 63.20 from where the entire rally originated, then of course you turn bearish. So if you ask me, I think 64 is too low, 68 maybe 72, whatever. But the risk basically to oil prices is to the upside, not to the downside. Even if you look at exogenous markets, markets are basically, or whatever you want to call it, economies, markets, blah, 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 are inflationary and not deflationary. So I have a hard time kind of thinking that, oil is a sell here long term.
Okay, thanks, Omar. Peter, I mean, on that point of risk on for oil is cheap at the moment compared to other commodities, other goods, etc. That argument, inflation. But what about, sort of evidence from China as we go forward into 2024? Does that matter anymore? Oil is cheap today, so is the only way up, is what I'm asking you, regardless of what we see happening in 2 or 3 of the biggest consumers in the world, US, OECD, or China?
Yeah, sure, Diallo. I mean, greetings from Sydney. It's wiped out 50 cents since this morning, so that's given us some indication. Also, you've had a weakening US dollar. So they're really in tandem. As the US dollar's been sucked down, so has oil. So it's a double whammy. And that needs to be all, if you're getting paid in US dollars, then that's not a good sign. Also, you've been mindful, gold's really had a nice uptick. It's now at $2,030. So, there's another mindset there as well. As far as how we look next year, well, we all understand Chinese exports, they were well down. We're looking at global exports are very weak. You look at German PMIs. There's no growth anywhere that's really outstanding, Diallo. I don't see any. So that's a real, I think, mindset that we're going to wrap our heads around as far as 24 and consumption. And if it's as bad as what it's, turning into, or I'm not saying manifesting, but if it's turning into, it's going to be a tough 24, then let's just see, where the oil market goes. It needs to, I think, obviously, they're going to see big cuts from OPEC, maybe not this week, but you will over the next matter of months. They want their price higher. And I think there's going to be a little argy-bargy between all players.
Okay, thanks, Peter. Jamie, I mean, back to OPEC and the argy-bargy that Peter just said. I mean, obviously, Saudi's been taking the brunt of voluntary cuts in the last few months. Those are going to continue into the first quarter, as they are by all sort of expectations. But there has been, as you were saying, talks on compliance going forward. Is Saudi going to accept cutting again alone, or is it, and can it really rope in players like the UAE and Kuwait to start to do that? And should OPEC be cutting more? I mean, is it kind of, it's putting itself into a bit of a corner, isn't it, if it keeps doing that and fighting against the reality of what's happening externally?
Yeah, the danger, of course, is if you keep on cutting, and we are expecting relatively robust non-OPEC production next year. So the risk is that you keep cutting, more production comes online, prices stabilize at the same level as before you cut, and you just end up on this constant market share drain. I think that looking ahead into Q1, as you say, a continuation of the Saudi cuts, I think that has to be the base case scenario, really. Without that, prices sink. So then, we're going into a relatively low demand season. Stocks haven't necessarily drained in the way that Saudi Arabia was hoping that they would after they introduced what was, let's remember, this was meant to be a 1-month cut at first, this voluntary 1 million barrels a day. Nobody expected it to be quite that short, but I don't think many people expected it to extend out until the end of 2023 and most likely beyond when it was initially put into force. So yeah, Saudi Arabia will definitely be looking to bring other people back into this. It's not just, there is the issue of compliance, there's also the issue of strong Iranian production growth over the last 6 months. We've probably kind of maxed out that growth largely. There's a bit more to come from Iran potentially, but not to the same extent as we've seen in recent months, especially obviously if the US actually gets its act together and starts implementing its sanctions with a bit more teeth again. Something they've been relatively reluctant to do.
Do you think Iran would expect, as Iran continues to increase its production? I mean, it's little increments, but they have been quite vocal in that. By March we're going to reach X. Going to add another 300,000, whatever. There will be no discussion of trying to even get it to join any cuts or any quota, right? I mean, they're going to have the argument that we've been left out for too long. Don't even think about it.
Yeah, exactly.
Yeah.
You clearly know the argument well there. There's no point in trying to bring the Iranians in. It would just massively complicate the issue and for fairly minimal gains, I would say. But yeah, looking ahead to Q1, I wouldn't be surprised if we do see some additional cuts from other players. Obviously very much time bound. I suspect Q1 would be when those would be meant to expire, once demand starts to come out of the doldrums a little bit. But frankly, the danger for these players will be that once you put these cuts in motion, suddenly you get locked into them, and the pressure in 3 months' time will be to extend again. So,
okay, thanks, Jamie. Omar, let's talk a bit about products and any support they're expected to get. We've obviously had jet recovering in the summer, more jet recovery expected supposedly out of China. But then we have these headlines about Germany's manufacturing, energy costs are too much, manufacturing is going to dwindle, diesel impact, etc. So where do you see that for sort of Europe and Asia, if you like, in terms of product cracks and where the direction's heading?
Yeah, no. So basically, I wouldn't buy cracks now. I think basically they need to fall a little bit. They've been holding up quite well on distillates. So you're talking calendar 24's trading, okay, something around $25, something like that. So I think it has to fall a bit more to be kind of interesting. There's no reason. The market right now is in kind of no man's land. Can it go up? Yes. Can it go down? Yes. Is there a trend long term? Then no. So I wouldn't be looking to I wouldn't be looking to be on the buy side or the sell side. I think we're coming. Let's see what happens in November, and then we have this OPEC meeting, etc. But if you put a gun to my head, $25 calendar 24, I'd sell it, not buy it. And if this market falls, I think basically this market needs to go down enough to become a no-brainer. So if we get to $70, let's say, if we get to 21 or something like that on the calendar 25 cracks, then yeah, those are all interesting. As to the news about what's happening in China, nobody knows, and I don't like trading on the back of reports about what's going to happen or not going to happen, or Germany and the whole of the EU in terms of manufacturing base is collapsing, and it's collapsing because they've turned away from Russian gas. It's that simple. So I don't think it has anything to do with, they want to pay extra for US LNG, and that's going to make them uncompetitive long term. Does that mean that it goes to zero now? No. Does it mean that it goes to zero over time? Yes. Does it mean that basically it's going to impact demand for diesel and all the rest of it? No, because the East will rise and the West will, or Europe will go down the toilet. So I don't think it matters really.
Okay, thanks, Omar. Peter, I mean, talking about gas and China, sticking with China, we have one of the headlines this morning about China gas demand is going to be increasing, and especially taking its raw gas from Gazprom. Is that a positive sign, or is that just regular cyclical seasonal demand? What should we look into that?
I think it's both. I think it's both, Diala. I think it's cyclical naturally, and I think that you've just got that. I suppose the inbound or the domestic consumption seems to be fairly strong. The economy is bubbling along. They're conscious as far as how it's looking from an export model. But internal demand, you've got 1.4 million people. You're running into winter. It's as cold as charity over there at the moment, and it's going to get colder over the next 2 to 3 months. So you need heating, you need demand, you need to keep the place warm, and there's the first part of it. As far as consumption, I think it will be relatively strong. And we all understand, it's been very strategic buying from China as far as the likes of iron ore. Many of their commodities are at nearly record import levels. So, I don't buy the story that things are that tragically bad over there. It's pretty damn good, actually, when you're looking at the big picture. They need food, they need fuel, and they certainly need base metals, and they need plenty of energy.
Okay, all right. I'll come back to you about China again, but just to keep you, Peter, you mentioned the US dollar earlier, that it's weakening. It's a little bit. Is that purely to do with the fact that now, or is it because people have accepted that rates are stabilizing, interest rates in the US, and so that's it. That's the new direction we're going in. and if anything, it's down with rates next year. So is the dollar picking up on that, or are there other factors that are?
I think there are other factors as well. I think it was probably cooked to the upside. Had very soft euro and pound. Yen was very much range bound. I mean, it was hovering around that 150, 151. It's back at high 148s at the moment. But the US dollar was cooked to the upside. It was very strong. The divergence between, from rate policy is the euro. I mean, we understand how the Fed came out of the blocks very quickly with rates. Eurozone was a little bit slower off the mark, and certainly the POMs, they didn't back down either. But now you're seeing both of those currencies strengthening a little bit further against the US dollar, and of course commodity currencies like our own. We're up 3.8% in the last week and a half, and so is the Kiwi. So I think everyone's been selling US dollars, Diala, and that's where you have a close look. That's why I mentioned gold. Gold's at 2,033. It was, I'll have to look at the charts, but it's probably only 3 weeks ago. It's put on $100. So it's had a really nice rally, and that's US dollar crushed and gold up, and that's been another key driver as far as markets. Okay, thanks, Peter. Jamie, let's talk a bit about the security situation in the Gulf. I mean, in terms of, not to get too far into it, but I mean, have a headline: tanker in the Middle East safe after US Navy respond. We had a couple of incidents last week of 1 or 2 tankers being let's say, interrupted in their flow by the Houthis. Is that causing any real concern going forward in terms of what more of that is just a headache? I mean, how much do you think that's impacting market sentiment?
I'd say both things that you said there are absolutely true. It is causing concern, but it's more on the headache level of concern that we're talking about here. The likelihood that there will be widespread impact on tanker flows is relatively limited. But yeah, clearly the Houthis are a potential problem around the Bab el-Mandeb, around the Yemeni coast. A lot of tanker traffic goes up through that choke point up into the Suez Canal, and then primarily onto Europe, also some of it heading over to the US. We've previously, not so far really to this level, but in this current situation, but we've previously seen disruption to tankers, some attacks around Fujairah, around the Straits of Hormuz there. So that would be the next escalation that people are worried about. But it would just be the odd attack on tankers. And if we get into that situation, we'll certainly see a lot more force projection from the likes of the US within the Gulf. I would say they've shown willingness to do that beforehand. Maybe a little bit more tricky around Yemen, but frankly, I think a lot of pressure will come to bear on the Houthis if they do step up incidents against tankers. There is obviously alternative routes that can be taken as well. It takes a very, very a lot longer, causes a lot more friction to global trade flows, a lot more cost for the end consumer who will have to pay for this at the end of the day. But skip the Suez Canal and go around Africa into Europe instead. So there are alternatives, but nobody wants to see us get to that situation.
Okay, Omar, just to go back to prices, are we seeing now a geopolitical risk discount firmly in place, do you think? I mean, have we kind of we've lost the premium, we're flat, and now if anything, headlines are being negative in terms of what we're seeing from the geopolitical risk situation, whether it's maritime security, whether it's an escalation possibly of this whole conflict. Where's the market sentiment out there? You're on mute, Omar.
I think there is no geopolitical risk premium in the price. I don't think there's, oil in terms of, Israel, Palestine, or Lebanon, or Syria. So no risk premium, basically, or Yemen. So I think there are wider kind of issues. I don't think that this market is. I think this market is going to trade with other markets. Okay, so you've seen the dollar come under pressure. I think that pressure is going to be sustained. I think basically we've seen lows on GBP and the euro at 103 and 95, 97, something like that. And I think You're going to see basically new all-time highs on both the euro and the GBP over time against the US dollar. So, the US has massive issues with its fiscal position. It has absolutely massive debt. It has massive debt, interest rate, costs to bear. Its deficits is ballooning. It's going to be 2 trillion this year, and probably even higher, if not, the same next year. It's unsustainable. So the dollar is going to come under a lot of pressure. That's a basic support for, commodities that trade in US dollar, because, other currencies are going to be, worth more against it. So again, I'm not too, if you see a ramping up of, if basically other players get involved, if Iran gets involved in the war, or the US hits Iran or whatever, then yeah, you'll see oil prices spike. But the way it is now, I don't think you'll see that. I think you'll see, I think you need to see more kind of an economic kind of thing come to bear.
Okay. Thanks, Omar. There's our survey question today, which is on demand. Weak OECD and China demand expectations will outweigh any additional OPEC plus cuts in 2024. If we get any additional ones on top of the ones that we're seeing. So is the demand scenario now really beginning to kick in? Yes or no? Agree or disagree? I mean, Peter, sort of on that point partly, but on the point that Omar just made about dollar has reached its peak. Would you agree with that? I mean, obviously it's an FX thing, but I mean, would you agree that the economic situation and the debt and deficit situation in the US is finally going to start hitting home next year, and obviously
you would think so.
Currency.
Well, absolutely. I mean, you'd have to say it's very hard to put an argument or a counter argument against Omar's thoughts, or Omar's argument is quite simply because it's true. And when you're looking at
but it's been true for many years. So I mean,
it has been true for many years, but we've also had very cheap interest rates. We've also pumped in trillions of dollars over COVID, and you've now ratcheted rates up to 5%. So there's the other side of it, and that's where it's going to cost you so much more to service that debt. So bondholders and all of those impacts. How does the US get out? Well, it's got relatively strong GDP at the moment, but are things going to, see a big change in 24? I've just got some notes here. Third quarter GDP estimate for the US is going to run around about 5% annualized, up from 4.9. So we've got those figures being released this week. We've got other core inflation data being released this week. And with energy prices at these sort of levels, it's not a headwind. It's a very good sign for central bankers, because they want oil to be at $60 a barrel, not impacting inflation decisions or inflation rates. And no one wants to see, the continuation as far as rate policy going up. So if we were sitting here, Diala, and oil was 110 or 120, I tell you what, it'd be a totally different world of what, from a rate policy standpoint and inflation. So there are many different moving parts to this. I'll just go back to when oil, and I'm just having a look here, it was at around about $1,830. It's put on $200 in just over a month and a half.
Gold.
Less than 2 months. Gold. Pardon me, gold. Sorry, gold. $200 in less than 2 months. So it's really ratcheted heavily.
Yeah, and I mean, one could argue that obviously the rate policy of the last year or more has also brought those. I mean, it has impacted oil prices, hasn't it? It is actually impacting demand. It's impacting, dollar-denominated debt and demand in those countries as well. So that's kind of all coming together there. Jamie, just back to you on that and talking about sort of economies. Let's talk about the Gulf a little bit. Again, we had some comments last week on whether, these prices are beginning to become a concern now for countries like Saudi Arabia, who have huge, expenditures in terms of their economic plans, etc. And Saudi taking out loans, even, I mean, it's playing around with its money markets a bit to that extent. It's not running out of money yet, but do you think it's a concern? I mean, how much at risk are those projects, and will Saudi possibly slow them down if this scenario continues?
Hey, Diala. Yeah, The thing I would say with Saudi Arabia is that it still has very low debt levels. So in terms of financing these projects, it doesn't need to just take it straight from oil revenues. They can hit the capital markets with relative ease, and there is a lot of people that are willing to lend to them. Obviously, high interest rates at the moment mean that is a more expensive issue than it was when they started a lot of these projects. But yeah, they're definitely capable of fulfilling them at the moment. They're not too concerned on that front. But as you say, if we enter a period of prolonged kind of a lower for longer price period, that then Riyadh has to start changing its calculus a little bit, and that's when we won't see these cancellations, but you might start seeing projects being delayed, starting to look around a lot longer to find cheaper tenders, just pushing out the whole time frame horizon for a lot of these projects that they've got on the board. But yeah, for now, I'd say alarm bells aren't ringing so much in Riyadh, and in the UAE, the issue is always not so much on the price itself; it's on this massive amount of spare capacity that they're sitting on because they've been subject to cuts for so long, and they've been investing hugely in expanding their production capacity. So very different kind of dynamics and views over that kind of price versus market share issue that you got in kind of the two main Gulf drivers of OPEC policy and of Gulf energy markets in general.
And I mean, do you sense that OPEC should get concerned again about non-OPEC supply, which has kind of been on the up and increasingly so? That includes US production, which had kind of tempered for a while. Any concerns there by OPEC?
Well, clearly, if you listen to OPEC ministers, their number one concern is always lack of investment in the industry. So they should be very happy that there's all this non-OPEC growth going in, because it seems to be that's what they've been calling for. But yeah, I'd say it's not so much the issue of non-OPEC growth per se; it's the fact that it's combined with very muted expectations for global demand. If we had strong non-OPEC growth, but demand was outstripping it by a few 100,000 barrels a day, that's no problem. It's the fact that we're more likely in a situation where non-OPEC growth is going to outstrip demand in 2024. If you listen to anybody other than the OPEC Secretariat's own report, which is kind of an outlier when it's on its projections for 2024 global oil demand.
And how much is Russia complying with what it's meant to be doing, in the last couple of months?
It's definitely slipped. So that's going to be an issue, not just with Riyadh looking to push Russia into higher compliance, but it makes it more difficult when you're trying to corral other producers into either improving their own compliance or more notably trying to deepen cuts, because everybody will just be pointing at Russia and saying, well, hang on, why should we make this sacrifice when Russia's freeloading on everybody?
Okay, there's our survey result, which is a bit dodgy, 50%, 50-50. That doesn't really tell us much. That's sometimes technical.
Tells you a lot, actually.
Yeah? What tells you that everyone's confused? What does it tell you?
Yes. Well, it tells you that there's no decisive viewpoint. That's what it tells you, and everyone has an opinion, and it tells me that from the marketplace, that proves that there are just as many buyers as sellers, or sellers as buyers, as far as whether they're bullish or bearish. That tells me a lot. So the market's going to the dynamics to drive the market. Yeah, I'd be interested to run that across X and put a poll out there for 24 hours and just see how many people vote. And
Peter, is there any sense from your point of view? I mean, you're not directly in that space of OPEC and what the countries are thinking, but do you think there will be an issue on this compliance with the large producers like Kuwait, UAE? I mean, Jamie just mentioned again, they're all increasing capacity and they do not want to be holding that back. How difficult is that going to make decisions for?
I think the greatest challenge, one of the greatest challenges, building on what Jamie said, as far as OPEC has always been concerned, and that is compliance, Diala. And so everyone has a weakened balance sheet. Everyone wants to get back to every single country, every member wants to see a strong balance sheet. They want to see strong earnings. And the way around that is to, pump till there's no more left and get as high a price as possible. And that normally was their mantra. And it's going to be interesting to see how that all, I suppose, materializes over the next month or two. And whether you go to see compliance angles or you go to see, members do their normal way of doing business, we're going to see a lot of interesting points into the market over the next 6 to 8 weeks as it digests this decision on the 30th of November, and then how it's implemented. And then the next part is execution.
Okay, thanks, Peter. We've run out of time, but Amar, very quickly, are you still as bullish on equities as you have been for next year in terms of,
I'm bullish everything. I'm bullish equities, I'm bullish Bitcoin, I'm bullish oil, I'm bullish gold, silver, platinum, GBP, euro, yes, and all for the same reason. I mean, I just love the fact that, people don't miss the kind of, simple stuff, and they keep looking at like, what's this doing? And, oh, no, they're selling in China and, Europe is yeah, but I mean, the overall kind of thing is the world is inflationary, not deflationary. The US dollar is weak. And you can see it. You can see it in Bitcoin. Risk premium is there. If you're holding cash, what are you going to do, right? You can't invest in bonds because, that's a very dangerous thing to do. Issuance is massive. Debt is massive. So the only way that the US can do anything is by inflating everything. So they and people look at they say like, inflation's at 3%. Yeah, the inflation last year was 10. So that's 10. And then on that inflation, you still got another 3. So basically, at the end of the day, what you've got to do is you've got to buy stuff that is unrelated to the US dollar. I think the US dollar has had its run. It's done it for 12 years, and it's time for the other stuff to come to the fore. So yes, bullish everything. I think the S&P looking for like 5,900, something like that over time. I think, you have the election. I've never known an election that's anything except inflationary. I've never known a war that's anything but inflationary.
Yeah.
Nobody's going to be cutting anything. Everybody's going to be spending. Look at Germany. They decided last week no more basically curtailing their spending, and they passed a new law to take out the old law that they have to stay within budget and all this kind of stuff. Nobody's going to do it because it's painful. And, in Europe, basically, you've seen the rise of the right, and because people are pissed off. So when people are pissed off, you don't come and tell them, you're going to cut services and all the rest. You're going to tell them you're going to spend more. So yeah, bullish S&P, bullish oil, bullish gold, silver, platinum, oil, all of it.
Okay,
yeah,
let's get those
Euros
checkbooks out. Thanks very much to Amar, Peter, and Jamie for joining us this morning. Great. Have a good week ahead, everyone.
Thank you very much.
Thank you.
Bye.
Thank you.
Have a good day.
Bye.
Like to watch, Omar.